Hey everyone, I'm Cary Smith and I'm sitting here with Amar Shah. And Amar, we have such a timely topic today. Our topic is about something we know is going to happen. We don't always know when it's going to happen, but we're talking about market volatility. And we've certainly been seeing a little bit of turbulence, but I think that we can bring some calm to the storm, right? Because there's a lot of historical perspective. So let's get into this topic on volatility.
Yeah, absolutely. I'm gonna share my screen here real quick and start with some truth around investing, right? I think the number one thing that we got to keep in mind is that no one can predict the future, right? Nobody has a crystal ball that can predict the future with a great deal of certainty, right? Like
Right.
the stuff that we do here at Client First Capital is all based off of math and probabilities and mapping forward. The other thing that is true is that the market needs active and passive participants, right? And what we're seeing with the volatility right now is that you know there are institutions that are selling, there's algorithms that are selling, and then you have individual retail investors that are selling as well, right? And so when you have all three going, then one leads the next. And so the reason why you need active investors is say like, hey, you know, the price of a stock, it may be here before like and right now we're talking about tariffs. It was right here and now it's dropped to down 30-40%. Even with tariffs, the fair market value is here, and then you get some active participants that are buying that can help stem the tide down. Um, so so this is just a reminder that the markets do need active and passive investors. Um, so you get good price discovery and you get lower costs overall. I think it's also important to remember that there's forced buying and selling by dealers, market makers that influence the movement of the markets. And uh, once you look at the market right now and you see a lot of institutions buying insurance by buying put options, that if we don't hit those levels, the market makers are forced to buy, right? And so we create artificial levels of support and resistance over time, right? And those changes, those levels change over time,
Right.
right? The other thing is that the Fed is the largest entity that drives liquidity in the market. We've seen a lot of pressure recently on the Fed to make some quantitative easing in all this uncertainty that's happening. And even they are saying that it's uncertain what's going to happen. And we do not want to create liquidity just to create liquidity because we also have this inflation problem that we've been fighting for the last 18 months plus. So um, with that, and I should preface, we've taken slides from Vanguard, Schwab, Fidelity, BlackRock. None of these slides are ours. Well, a couple of them are, but most of them are third-party slides. And if you like them, we can reference them at a later point here. So, or since 1972 or 1980 till now, there's been 13 bear markets, and a bear market is defined by a drop of 20% or more. Um, this slide here kind of gives you some context, and you can see time frame of bear markets and bull markets, and kind of like the impact that they have had on investments. So real quick, bear markets last on average 14 months. You can see here on the bottom of the slide, some of these have been 1 month. Uh, some are 31 months, like the dot-com bubble bust there. And then bull markets are obviously longer. So if you look at this blue, there's a lot more blue on here than there is red. And that shows that the bull markets, it takes longer to grow, but you grow more, right? And you want to capture as much of that growth as possible by owning the market, right? And so,
Yeah, I like this chart, Amar. I think that this alone can help people, just kind of understand that what we're living through today, although we don't know the duration, is probably going to be relatively short compared to what's the market that's going to follow this as things start to improve.
Yeah, absolutely. And when we look at the current market scenario, I mean, there's four key variables that no one knows right now. No one knows what foreign countries are going to do with tariffs. We
Right.
don't know what the executive branch is going to do with tariffs. We don't know what Congress is going to do with tariffs. So keep in mind, if we're not in a wartime situation, Congress is the only entity that can levy tariffs, right? And then there's actually four lawsuits that have been put in by these think tanks that are challenging the tariffs, the legality of those tariffs itself, and so that will go to the Supreme Court, I would assume, and then there can be a decision made there. So even though we're living in this world where tariffs are going to be a reality here shortly, there's so much variability and uncertainty that it's hard for to say that they're here for that long.
That's right.
The next slide here that I'd like to highlight, this one's actually from First Trust. When we're looking at the S&P 500 and we're looking at the days of volatility, it's almost three to four times a year you'll have a drop of 5% or more. And the last time this has happened was just recently in a day in March, right? 10 to 15% is less common. 10% is probably a little bit over a year. 15% is probably every 3 years. And then every 5.5 years, we have those bear markets that we see. So those are what we want to avoid. 5, 10, 15, it's normal market cycles. And you could be triggering, tax events with this. Any thoughts on this page, Cary?
No, I like the slide. I like the perspective that it gives for people who may be concerned about the markets today.
Yeah. And remember, whenever we have a 10, 15% drop, what's creeping in the back of our mind is, oh, this time it's different, right?
Mm-hmm.
And things are going to change. The reality as shown is that oftentimes markets have experienced these type of market cycles in the past. Maybe not the same factors that are influencing it, but has figured out a way to rebound in the past.
Right.
This chart actually shows that in more visual terms. So if you look at this chart, you'll see two things. The first thing you'll notice is, at least in my eyes, the orange bars that are going down. Those are intra-year declines. So within the year, from January to December, what is the largest decline that happened during that time period, right? The blue lines give you what was the total return for the whole calendar year. And so when we look at this, you can see here that there have been years where there's been an intra-year decline of 39, 40%. And then at the same time, at the end of the calendar year, you can have a positive return, right? So this is just to highlight, the fact that intra-year declines are common. What's also common is that when you look at, if you zoom out and you look at the best trading days and the worst trading days, a lot of them cluster around the same time. So if you're kind of feeling like, oh my God, this volatility is intense, this is going to get worse, and you pull your funds out of the market and go to like cash or a conservative account, you have the potential of missing out on some of the best trading days in the market as well, right? So you paid for the roller coaster down, and you don't get any of the benefits. And so just a word of caution to that. This slide's by Vanguard, and what Vanguard has done their research is that if you take a 60-40 portfolio, and let's say you take your portfolio and you move to cash relative to a 60-40 portfolio, what is the probability of outperformance? And in the short term, 74% of the time, a 60-40 portfolio would outperform just moving to cash. In 6 months, a year, that number becomes 87%, right? So you got to think of our long time horizons. Even if you're just entering retirement, you're going to be in retirement for a good 20 years, right? And if you're at the tail end of retirement, if you're still aggressive investments, then you're probably investing that portion for generation 2 or 3, right? So that time horizon definitely needs to be a part of that conversation. This slide's from BlackRock. This is the largest single day decline in markets, average about 9% if you look at the top 15 worst. 1 year later, on average, we were up 30%, right? So one day doesn't make or break, what the year will outcome the following year. And so here you can see, even with sell-offs with the Gulf War, tech bubble, trade wars, inflation shocks, the market still did recover after these things. This slide here, want to highlight, the more risk you're taking, the more volatility you can face. The less risk that you're taking, the less volatility you'll face, but the lower rate of return you will average. So let's take somebody that has 100% in bonds. The average return is 5%. The max return that all bonds has received from 1926 to last year has been 32%. The worst it's ever done is 13%, right? So those are the two ends of the spectrum. 5% is where most people end up on average, right? And then if we look on the other side of the spectrum, minus 43 is the worst, 54 is the best, and on an average, it's about 10.5, right? So this is the reality of investing, is that the volatility metrics really can kind of emphasize, the ride that you're taking to get to your returns. Here at Client First Capital, just want to, as a reminder, we do things differently. We have a dynamic risk model, and we pair that with a consistently conservative model, and the two combined become your overall portfolio, right? And so the dynamic risk model is kind of like cruise control, like the newer days cruise control. So in the early 2000s, if you put cruise control on your car at 60 miles per hour, it would go 60 miles per hour regardless of the environment. So if there was rain, if the road was curvy, you're still going 60 miles per hour.
Right.
Somebody cuts you off, you're still going 60 miles per hour, right? Risk is going up, but you're sticking to that model. That is traditional asset allocation. That is what all the big box firms do. That's how they scale their business. It's been around for decades. What we are doing is kind of like adaptive cruise control, where we're reducing the amount of risk when we can measure the risk and the risk is changing, right? And so there are two things that happen here, is that when we measure risk and risk is increasing, we're going to automatically reduce the amount of risk that we're taking in our investments. However, we all know, especially if you're in California, people drive on the freeway 80 miles per hour and it's raining and they're still driving 80 miles per hour. Cary, would you say that's the same in Arizona?
I would say that's pretty close.
Yeah, and sometimes those people make it home safely. They're not hurt. And so there is a potential to lose out on some upside return. The second thing is that we can't map all risk, right? And that's why we have the second portfolio, which is a defined outcome, which is consistently conservative. It's basically that portfolio buys you enough time for the risk assets to recover, right? And so, with this tariff situation here, that's creating a lot of uncertainty for risks that we can't measure, and people don't know what to measure right now. And so, we're being cautiously optimistic, and we're going to wait and see how this trickles through the economy. Our CFC1 portfolio, just to highlight, we have a 5-step process where we understand growth and inflation, and that's our economic lens because that's the gravity of the markets. We map asset classes because the market and the economy are two separate things, as we are seeing right now, where the markets are tanking. The economy is pretty stable. It's and markets trying to front run what the economy may do. We look at institutional flows to find market makers where the options are creating artificial resistance and support bands, right? And so we look at that to kind of define our process. Cary, any closing thoughts?
Yeah, I do, Amar. So, at Client First Capital, we've been in the process, as I hope other firms are doing now, but reaching out to clients, right, in amidst all of this volatility to understand how they're feeling, and you've made several of those calls, and the feedback from our clients so far has been very positive. So they understand what's happening in the market, they understand how their portfolios are working. Most of them are seeing less downturn than what the market is presenting, right? So they're in better shape than the market, and so I think that shows that that our process is working. Our clients are happy with it, and if that's not your situation, it may be worth reaching out to Client First Capital, at least have a conversation about it and see how maybe we could help you in your asset management in your portfolio.
Sounds good.
Okay.
Thank
Thanks,
you,
Amar.
Cary.
See
Yep.
ya.